Imagine you save $200 a month starting at age 30. By the time you hit 70, you've built a nest egg. But here's the kicker. The interest rates on 30-year fixed mortgages are projected to sit between 8 and 9% throughout 2026. That's not a temporary blip, that's the baseline. Now, think about what that does to the math of paying off your home. Traditional wisdom says, wait until you're 70, then pay off that mortgage with your retirement savings. But at 8% interest, every dollar you keep in your low-yield savings account is losing ground to the bank's interest charge. If you owe $200,000, paying it off at 7% saves you $15,000 in interest over 30 years. At 9%, that savings jumps to over $19,000. Suddenly, the equation flips. Instead of waiting decades to pay off your home, the smart move becomes paying it off earlier, even in your 30s or 40s, because the cost of carrying that debt outweighs the returns you'd get from investing that money. Say you owe $300,000. At an 8% rate, your monthly payment includes about $2,000 in interest alone. If you use your retirement savings to pay that off, you're effectively earning a guaranteed 8% return instantly. No stock market risk, no hidden fees. It's a guaranteed, risk-free gain. So why wait? Why let your mortgage balance grow while you're just watching your investments crawl along at 6 or 7%? The high rates of 2026 make your existing loan expensive, turning your home from an asset into a heavy liability. The old rule of waiting until retirement no longer applies. In fact, the sooner you clear that balance, the more financial freedom you gain, especially in a high-interest environment. Don't just watch your money work for you. Make sure it's working harder against the clock. Think of your mortgage as a guaranteed investment vehicle that's sitting idle, quietly eating away at your wealth every single month. If you're currently carrying a balance at 8%, that debt is costing you a hefty return before you even make your principal payments. But what happens if you lock in a 3.5% rate today? That shift alone transforms the entire financial equation. Let's walk through a concrete scenario to see the impact. Say you have a remaining mortgage balance of $200,000. At an 8% interest rate, your monthly interest portion alone is roughly $1,500. Over the next decade, that compounds into tens of thousands of dollars in pure interest expense. Now, imagine locking in that 3.5% rate instead. Your interest-only payment drops to about $583. That's a difference of nearly $900 in monthly interest costs. Over the course of just 5 years, that savings amounts to more than $54,000. That's not just money you're keeping. It's money you're actively deploying. Instead of watching your cash sit under a mattress or chase uncertain market returns, you've turned your mortgage into a low-yield, risk-free investment. You've effectively created a financial buffer that grows your net worth, even while you live in the house. This isn't just about lowering a payment. It's about maximizing the efficiency of every dollar you put toward your home. By securing that lower rate, you're ensuring that your capital works harder against the clock, freeing up resources for other opportunities, investments, or unexpected life changes. It's a powerful way to take control of your financial future. Now consider what happens if you wait until retirement to tackle that balance. Picture this. You've delayed paying down your home, and by the time you hit 70, you're relying entirely on Social Security and investment income to cover your fixed mortgage payment. But retirement isn't as predictable as it once was. Social Security benefits can be adjusted downward due to economic shifts, and your investment portfolio could face a significant downturn right when you need it most. A fixed mortgage payment acts as a financial anchor, giving you a predictable expense that doesn't fluctuate with market swings. If your investments drop in value, you still have to make that same payment, which can quickly drain your resources. Imagine you owe a substantial amount and your investments lose 30% of their value in a single year. Suddenly, your fixed payment feels much heavier, forcing you to either cut back on essentials or dip into your emergency fund. By contrast, paying off your home earlier provides a safety net. It frees up cash flow that can be redirected toward building a more resilient retirement portfolio or covering unexpected costs. Think of your mortgage as a balloon of future debt that could grow larger and more dangerous if left unchecked by market volatility. The sooner you reduce that balance, the less exposure you have to these unpredictable forces. A lower or zero mortgage payment means your monthly expenses remain stable, no matter what the stock market does. This stability gives you the confidence to make other financial decisions without the constant worry of whether you can afford your housing costs next month. It's about creating a fortress of financial security that withstands the inevitable ups and downs of retirement life. Imagine a scenario where you decide to delay paying off your mortgage, trusting that you simply have more time on your side. The common wisdom suggests that waiting 15 or 20 years to clear your home debt is harmless, just another step in a long financial journey. But look closer at what actually happens during those decades. Compound interest doesn't just sit idle. It works tirelessly against you, especially in a high-rate environment where the cost of borrowing remains stubbornly high. Over a span of 2 decades, that initial balance grows in complexity, not because you added more money, but because every single dollar of interest paid earlier compounds into a larger obligation later on. Think of it this way. If you owe $20,000 at a 22% annual rate, and you wait 20 years without making significant principal payments, the sheer volume of interest accrued can dwarf the original loan amount. By then, the total interest paid could easily exceed the principal you originally borrowed. This erodes the true benefit of early payoff, turning your home from a stable asset into a financial anchor that drags your net worth down. The longer you wait, the more the power of compound interest shifts from your advantage into a heavy burden. Instead of building a fortress of security, you end up constructing a tower of debt that takes longer to dismantle than expected. So, when you consider waiting, ask yourself if you're truly just buying time or if you're allowing your expenses to outpace your growth. The high rates of recent years mean that every month of delay costs you significantly more than in previous eras. Waiting doesn't just mean paying less interest. It means paying a lot less interest, which might surprise you. The result? A massive chunk of your retirement savings gets consumed by what could have been avoided, leaving you less secure when you finally decide to strike out. Think about your mortgage as a guaranteed, low-cost loan that you could keep paying instead of eliminating. Say you still owe $250,000 on a home purchased in the early 2020s, and your rate sits at just 3.5%. That sounds tiny, but every dollar you use to pay down that balance is a dollar not working for you elsewhere. If you choose to hold on to that cheap debt and invest the difference in a diversified portfolio, earning a steady 7% annual return, your net worth grows faster than it would if you wiped out the loan entirely by age 65. By the time you reach 65, that early investment has compounded into a substantial sum, while your remaining mortgage balance stays small. Now consider what happens if you wait until 68 or 70 to pay it off. You've freed up cash flow for decades, allowing your investments to compound further, yet your final balance sheet often shows you with more total assets, but also a longer period of carrying debt. This extended timeline can erode the safety net you built earlier, especially if market returns dip temporarily. Imagine you saved $200 a month since age 35. At 65, those savings could have grown into over $1 million if invested wisely, whereas paying off your mortgage by 70 might leave you with nearly that same amount. But you'd have missed out on the extra growth from compounding returns. Essentially, delaying the payoff until your late 60s or 70s means you're holding onto a liability longer than necessary, reducing your overall financial resilience. The key takeaway is that balancing a low-rate mortgage with smart investments often creates a stronger financial position than erasing the debt entirely in your mid-60s. Think about what happens if your home is debt-free, but your investment portfolio takes a sudden hit. Say you saved $200 a month for years and finally paid off your entire mortgage in your early 70s, only to face a market dip the following year. You no longer have that monthly mortgage payment acting as a cushion, so a 10% drop in your assets means your total net worth shrinks faster than expected, leaving you more exposed to unexpected expenses like medical bills or home repairs. That's why keeping some cash reserves is crucial, even if you've cleared your debt. Imagine you owe $20,000 on your home and hold $5,000 in savings. If you use those savings to wipe out the loan entirely, you eliminate a fixed cost but reduce your liquidity. Now, if an emergency arises and stock markets are down, you might be forced to sell assets at a loss instead of drawing from a safe, separate emergency fund. In 2026, with interest rates stabilizing but economic uncertainty remaining, a low-rate mortgage can actually serve as a form of protection, especially if your investments are volatile. Instead of viewing the mortgage as an enemy to be defeated at all costs, consider it a strategic tool that balances risk. Keeping a portion of your capital liquid allows you to weather storms without dipping into your long-term growth investments. This approach ensures that even if you face a sudden downturn, your overall financial stability remains intact, giving you the flexibility to make smarter decisions rather than reactive ones. After all, The goal isn't just to own your home outright. It's to own your freedom with a safety net that works for you, not against you. Now, think about what happens when your income drops. In the earlier part of life, maybe you had a high salary and your mortgage interest was fully deductible. But by 2026, as you move into retirement and your taxable income shrinks, that tax break starts to fade. You might only be able to deduct a portion of your interest, or maybe none at all, depending on your filing status and other income sources. This means the effective cost of carrying your mortgage debt rises over time. So, when does paying off your house make more sense? Let's say you saved $200 a month over the last decade and still owe $180,000 on your home. If your mortgage rate is 6% and your tax bracket was 32%, you might have thought your effective cost was around 4.1%. But now, if your income has fallen and your tax deduction is cut in half, that effective rate climbs back up to 6% or more. Suddenly, keeping that loan feels less like a manageable expense and more like a ticking time bomb. The break-even point, where paying off the house starts to save you money compared to letting it sit, comes much earlier than you expected. You might not need to wait until you're 70 to decide. Maybe by 65, your tax liability has dropped enough that the real benefit of ownership outweighs the convenience of a lower monthly payment. It's not just about owning your home. It's about owning your freedom with a safety net that works for you, not against you. But what if you choose to hold on to the property instead of paying it off completely? You start earning rental income, sure, but here's the catch. With interest rates this high, that rental income might barely cover your 3.5% mortgage. Imagine you've got a property rented out for $2,000 a month, and your mortgage payment, including taxes and insurance, comes to $2,000. You're left with only $20 in profit every single month. That's not a real safety net. That's barely breaking even. Now consider what happens if rates tick up another fraction of a percent or if vacancies stretch for a few months. Suddenly, that income turns into a drain on your cash flow, eating into the very buffer you were counting on. Think about your mortgage as a flexible tool rather than a fixed cost. If you keep the house, you're betting on market stability that might not deliver. Say you saved $200 a month and built a nest egg over the years. Now, instead of letting that money compound freely, it's tied up in a property that's just hanging on for dear life. The benefit of keeping it rented until age 70 shrinks because the yield barely offsets the debt. It's like driving a car where the gas price equals the car's value. Every mile you drive costs you almost as much as you paid for the vehicle itself. So, when you're weighing your options, don't just look at the headline number of rental income. Ask yourself if that income is truly covering your obligations with room to breathe. In 2026, the line between profit and break-even is razor thin, and crossing it the wrong way can leave you vulnerable. Your goal is to own your freedom, not to tie your future to a property that's just surviving. Picture a path forward that transforms your mortgage from a looming deadline into a manageable milestone. Instead of waiting until age 70 to clear your balance, you can accelerate your timeline while keeping enough cash on hand to handle life's surprises. Start by refinancing your loan to a 3.5% rate today. This lower cost reduces the drag on your monthly payments and frees up resources for future growth. Next, build a robust emergency fund that covers 6 to 12 months of living expenses. Think of this as your financial shock absorber, ensuring you never have to dip into your home equity or pay penalties when unexpected costs arise. With a secure foundation, set a clear target payoff date of 68 instead of 70. This adjustment creates a balanced approach. You still enjoy decades of home ownership, but you also gain the flexibility to invest in opportunities or weather downturns without stress. Imagine you owe $200,000 on your property. At 3.5%, your interest burden shrinks significantly, allowing you to apply extra payments toward principal without sacrificing liquidity. By age 68, your balance could be nearly zero, leaving you debt-free and ready to explore new ventures or simply enjoy the freedom of owning your nest egg outright. This strategy doesn't rush you off the market. It ensures you arrive with both feet firmly planted. You've built a legacy of stability, not just a ticking clock. Take the next step today by contacting your lender to discuss refinancing options and reviewing your current amortization schedule. Ask yourself,